Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, it feels like a long time since Liberation Day and the associated equity market sell-off. US trade policy, of course, has seen a marked shift from higher than expected tariffs in April to what is now increasingly progress on trade negotiations in the month of May. And so far, we've got the outline of a trade deal with the UK and the start of trade talks between the US and China in Switzerland. Now, markets, of course, have followed this flip-flop, and the S&P 500 has now largely reversed all of the drawdown after the imposition of trade tariffs. So the key question in front of us, in front of investors today, of course, is does this equity rebound have legs? Now, to help answer that question, I'm very happy to be joined today by Raymond Cheng, our Chief Investment Officer for North Asia. So welcome, Raymond. I guess that's the big picture question, of course, today on equities. But maybe let's start with trade. In your view, how does the recent progress on trade impact your views on financial markets?
Sure, Manpreet. To answer your question here, we focus on two key upcoming event risks. First is trade policy. Now, we expect more trade deal conclusions, which should sustain the equity rally, especially with the 90-day tariff pause ending in early July. Second is economic data. We expect relative resilience in hard data in terms of real economic activity to sustain market gains, despite some recent weakness in soft sentiment data from surveys. But with progress on trade negotiations and Trump's deregulation agenda, soft sentiment data may improve in the near term. Now, as a base case, we still expect the US economy to achieve a benign soft landing, with growth slowing below trend. While a hard landing remains a risk, we do trim the probability of a recession happening from 30% to 25%. The latest Moody's US sovereign rating downgrade highlights concerns about US fiscal deficits, but we view a significant impact on bond markets as more of a tail risk. Now, based on this macro assessment, we have upgraded equities to a modest overweight, factoring in the improved trade outlook while staying mindful of the concerns about the US deficits. This is funded by a downgrade of gold to a core holding. This reflects our view that gold may undergo a period of consolidation and approach $3,100 per ounce within the next 3 months, given elevated bond yields, easing trade tensions, and fatigue from the Asian buyers at the current high levels. Now, our constructive view on equities, on the other hand, is underpinned by both technical and fundamental drivers. Technically, our short-term 1 to 3 month technical models have turned bullish on US and China equities. We see room for US equity momentum to run further, given we're still months away from July when the 90-day tariff pause ends, especially if we do see a few more trade deals and Trump can implement his deregulation and tax cut agendas. Fundamentally, the US Q1 earnings season has been strong, which proves the sell America trade a bit excessive. Within US equities, we have added an opportunistic buy idea on the semiconductor sector as a beneficiary of easing trade tensions and improved global economic outlook. That said, we emphasize the importance of ensuring adequate diversifications across major regions. We view Euro area and Asia ex-Japan equities as core holdings, with pullbacks as opportunities to rebalance. Within Asia ex-Japan, we are overweight Chinese equities, given the additional support from domestic stimulus. We retain India equities as a core holding, given a possible US-India trade deal, strong earnings growth, and foreign investor inflows. Both Asian markets should, in general, benefit from a weaker US dollar as well.
Thanks, Raymond. I think that's a great overview in terms of our views on equity markets and gold. But what about bonds? Because US yields have ticked noticeably higher in the month of May. So has that changed your view on bonds?
Yeah, we do view bonds as a core holding and believe it's attractive to buy high quality bonds at current yields. Barring an unexpected inflation shock in the US, the 10-year government bond yield is expected to fall to the 4 to 4.25% range in our base case of a soft landing scenario, or in a hard landing scenario below 4%. A surge in yields on the back of US fiscal deficit concerns is a key risk, highlighted by the US credit rating downgrade. However, studies of sovereign credit stress over the last few centuries do argue that imbalances can persist for long periods. This supports the case for viewing this as more of a tail risk in the absence of a trigger. So we do now see attractive value in longer maturity bonds as well. Now, these bonds offer exposure to an expected move lower in yields. Extending this same thought, we turn opportunistically bullish on the 20-year plus US government bonds. Also, we like the UK government bonds on an FX unhedged basis, on the view that UK policy rates have more room to fall amid soft growth outlook, and also a British pound should benefit from a soft US dollar view as well.
All right. Thanks, Raymond. Maybe picking up on that last point on the dollar, right? I mean, the dollar has been volatile and actually it's shown notable weakness most recently against Asian currencies as well. So, in your view, is that weakness set to continue?
Yeah, we do expect the US dollar DXY index to rebound somewhat over the next 1 to 3 months, but then weaken again over 6 to 12 months' time. Now, let me explain why. Now, in the near term, our expectation of renewed appetite for US assets and closing of earlier bearish positions should offer some support for the US dollar. Now, this should reduce demand for safe haven currencies, especially those with low borrowing costs. However, we expect this US dollar bounce to be transitory. Ongoing rotation out of US assets and elevated US dollar valuations will likely lead up to a modestly weaker US dollar in the longer term. Now, we expect the DXY index to strengthen to 103 in the near term, but then taper off to 98 in 12 months' time.
All right. Well, I think that's short and sharp, but I think brings us to the end of the conversation today. So thanks, Raymond, for taking the time to speak to our listeners today. As always, if I can sort of share my top 3 takeaways from our conversation. Number 1, of course, is that we still expect a soft landing in the US economy in our base case scenario, and hence we upgrade global equities to a modest overweight. Second is that within equities, a key message is still one of diversification and ensuring a balanced approach across major regions. But of course, we hold a slight preference for the US and China within that. And third, of course, gold, most likely seeing near-term consolidation, but high-quality bond yields potentially offering an opportunity as yields trade at the top of their recent trading range. So that's all we have for today. We have published our latest edition of the Global Market Outlook alongside. So please do have a look at that if you want to dig a little bit more into detail on today's conversation. Thank you very much for listening in today, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.